You know how you always hear that you got to diversify your investments? Like it's personal finance 101.
Oh, absolutely. Don't put all your eggs in one basket, right? Classic advice.
Totally. But what if, and stick with me here, what if some of those baskets are like secretly connected? You think you're spreading your risk, but then bam, something happens and all those investments tank together.
You're hitting on a really important point. It's not just about what you invest in, it's how those assets actually relate to each other. That's where understanding asset correlation comes in.
Okay, so let's unpack that. What are we really talking about when we say asset correlation?
Well, it's basically a way to measure how two assets tend to move together in the market. Do their prices kind of move in sync, or do they do their own thing?
So like if one goes up, does the other one usually go up too? Or down?
Exactly. And we can actually put a number on that relationship, a correlation coefficient. It goes from -1 to 1, or sometimes you'll see it as -100% to 100%, which can be easier to visualize.
Percentages, got it. So if two assets have a correlation of 1 or 100%, that means they're like joined at the hip, price-wise.
Exactly. When one goes up, the other goes up by the same amount, proportionally speaking. And then on the flip side, a correlation of makes 1 or makes 100% means they move in opposite directions. One goes up, the other goes down.
Like a seesaw.
Perfect analogy.
Okay, that makes sense. But why does this even matter for someone who's like actually investing their money or trading?
Well, investors and traders, they both actually use correlation, but their goals and how they use it are pretty different. Let's start with investors. They're usually in it for the long haul, right?
Yeah, thinking about things like retirement, long-term growth, that kind of thing.
Exactly. So for them, correlation is all about managing risk through diversification. They're not trying to time the market perfectly. They want to build a portfolio that can handle ups and downs.
So if one part of their portfolio takes a hit, other parts might be doing okay because they're not all moving in the same direction.
Exactly. A classic example is gold. You've probably heard of gold being a safe haven asset.
Oh yeah, like when things get crazy in the market, people flock to gold.
That's the idea. Historically, gold has often had a low or even negative correlation with stocks. So when the stock market takes a dive, gold might not move much, or might even go up, which can kind of cushion your portfolio a bit.
Interesting. So instead of panicking when stocks are down, a smart investor might actually see that as a chance to adjust their portfolio based on these correlations.
Exactly. They might even use that correlation coefficient number we talked about to get a really precise understanding of how their portfolio might react if the market goes up or down.
Makes sense. Okay, that's super helpful for investors, but what about traders, especially in the world of Forex, where it's all about currencies? How does correlation play into their strategy?
Traders, especially in fast-moving markets like Forex, tend to use correlation in a more tactical way. They're looking for short-term opportunities, trying to get an edge by understanding how different currencies might move in relation to each other.
So instead of long-term risk management, it's more about active trading strategies.
Exactly. And there are a couple of major ways they do this. One is hedging, which is all about managing risk.
Okay, so kind of like a safety net for traders.
Oh, yeah. You can think of it that way.
Yeah.
Let's say a trader thinks a particular currency pair, maybe the euro against the US dollar, is going to go down. They might open a short position, which basically means they're betting on that decline. But they also know the market can be unpredictable, right?
Right, things can change quickly. So to manage that risk, they might use these correlations as a kind of hedging tool.
Exactly. They might look for another currency pair that usually moves similarly to the euro-US dollar, something with a history of high positive correlation.
Okay, so let's say they see that the British pound often moves in the same direction as the euro, at least against the US dollar. Then what?
Well, they could open a smaller position in the British pound-US dollar pair, but this time a long position. That way, if their bet on the euro doesn't work out and it actually goes up, the potential gains on the pound could balance out some of those losses. It's a hedge.
Ah, that's smart. So they're not trying to completely avoid the risk, but they're using correlation to kind of soften the blow if things don't go their way.
Exactly. It's about finding that sweet spot between profit potential and managing your risk. Now, on the other hand, some traders use correlation for what's called momentum trading, which is a bit more, shall we say, adventurous.
Momentum trading. That sounds like jumping on a trend early on, trying to ride the wave.
You got it. Momentum traders, they look for currency pairs that are showing a strong correlation and a clear trend, up or down. Their thinking is, if two currencies are really closely linked and one of them makes a big move, the other one's probably going to follow.
So they're trying to hop on that train and profit from the momentum.
Exactly. Let's say the Canadian dollar has been on a roll against the US dollar, and we know historically it has a pretty strong connection with oil prices. Now, if a trader sees oil prices suddenly shooting up, they might take that as a signal to buy Canadian dollars, figuring it's going to keep getting stronger along with oil.
Makes sense. So whether it's hedging or momentum trading, understanding these correlations is key. But you mentioned earlier that those relationships aren't set in stone. What makes them change, especially in the world of Forex?
Well, that's super important. There are a bunch of factors that can shake up currency correlations. One of the biggest is economic data. Each country's got its own economic indicators, things like inflation, GDP, jobs reports, all that.
Right, and those reports can really move the markets.
For sure. Let's say, for example, the U.S. Federal Reserve decides to raise interest rates, and it's a bigger hike than everyone was expecting. That could make the U.S. dollar stronger against other currencies. But how much stronger depends on how other countries, like their central banks, react.
So even if two currencies usually move in a similar way, something unexpected like that could throw things off for a bit.
Exactly. That's when things get really interesting for traders, watching all these moving parts. Another thing that can really impact correlations is geopolitics.
Geopolitics, so like elections, trade agreements, even conflicts, stuff like that.
Exactly. Those events can create a ton of uncertainty, and the currency markets really don't like uncertainty. You'll see some currencies actually benefit from that, though. They're seen as safe havens when things get rocky.
Right, like we were talking about with gold earlier. Which currencies are considered the safest?
The Swiss franc is the classic example. Switzerland's been politically neutral forever, and their economy is very stable. So when there are global tensions, investors often move their money into Swiss francs, and that pushes the value up.
Makes sense. It's like the Switzerland of currencies, right? Calm and neutral no matter what's happening.
Perfect analogy. And then there's the Japanese yen, which also tends to be seen as a safe haven, although Japan's economy is so tied into global trade that it's a bit more complicated.
So depending on what's going on in the world, those safe haven currencies might suddenly become less correlated with other currencies that are seen as riskier?
Exactly. And then, of course, there are times when a single event can just completely upend all the usual correlations across the board. The 2008 financial crisis is a great example of that.
But yeah, that was a wild time for the markets. Nothing seemed to be moving the way it was supposed to.
Absolutely. During that crisis, correlations that people had come to rely on, relationships between assets that had been stable for years, they just went out the window. It was a real wake-up call for a lot of investors and traders who'd been depending on those historical correlations.
So it's not enough to just look at past data. You have to be aware of what's happening right now in the real world and how that might be affecting things.
100%. You got to keep the bigger picture in mind, the economy, geopolitics, and how those forces could be impacting correlations in real time. It's dynamic, not static.
Okay, we've covered a lot today. For our listener who's maybe still wrapping their head around all this, what would you say is the most important takeaway when it comes to asset correlation?
That's a good question. I'd say the biggest thing to remember is that correlation is a tool. It's powerful, but it's not about seeing the future. It's about understanding how interconnected everything is in the financial markets and that those relationships are constantly changing.
So it's more about staying informed, being ready to adapt, and maybe even questioning those assumptions we might have about how things usually work.
Exactly. Because, like we've seen, those correlations that seem rock solid, well, they can shift when you least expect it. And those shifts, they can be real opportunities for anyone who's paying attention.
That's a great point to wrap up on. So for our listeners who are ready to learn more about asset correlation, are there any resources or tools you'd recommend?
Definitely. There are a ton of online resources that track correlation data for different assets, and they update in real time. And there are charting platforms where you can actually see these correlations visually and see how they change over time.
Awesome. We'll be sure to share some links to those in the show notes. And with that, we've reached the end of our deep dive into asset correlation.
This was great. Thanks for having me.
It was a pleasure, as always. And to all our listeners, thanks for joining us. We hope you learned some new things about the world of finance. Catch you next time.
Thank you for watching. Don't forget to check out the description below for more content related to today's episode. You can listen to our podcasts on various platforms. Plus, we have an exclusive offer for you. Use our discount code to get 10% FA off and potentially save up to $120 on your first purchase at FTMO. If you enjoyed this video, please like, subscribe, and share your thoughts in the comments below. Happy trading!